Good morning, everyone. Today we are going to discuss the topic which is taxation of self employment income. In our previous class, we have discussed about the property taxation income, and if you have not watched that video yet, go and have a look at that video because that will cover all the concepts but in a revised mode so that you can quickly study it on the day of your examination. Now, the next topic, which has a high weightage in exams, is self employment income because this chapter will cover almost around 15 to 18 marks. And yes, in ATT examination, there is always a question of 15 to 18 marks in business taxation, which is paper 2. And in ACCA also, this will cover uh, a huge portion of scores in the examination. So, the first topic which we discussed was property taxation income. Now, we are going to discuss the second topic, which is self employment income. Before going to that, let me quickly go to the performa that we study in chapter 1. First is non savings income. Non savings income will include income from employment, which means when you are performing the duties of your job. Then, next would be property income, where you let out certain properties to earn money from that. And then is self employment income, which means income which is earned from a business, and that business could be of selling of goods, it could be trade, it could be selling of services like the profession, chartered accountant, doctor, lawyer, etc. Or it could be from vocation as well. And the vocation means when money is earned out of passion, out of hobbies, like somebody who loves cooking and then starts earning money from that. Somebody who loves acting, so acting, cooking, all these things, right? Now, then the next was savings income. What will be covered in savings income? Savings income would include interest. This interest could be from banks or it could be from building societies. And the last topic of this would be dividend income. When you're earning dividend from UK or non UK based companies, or it could be from trusts. So that is called as dividend income. Now, once you have these three heads of incomes, non savings income, and dividend income, we get a figure of total income. Now, out of this total income, we will study in the further chapters. Some adjustments are made to total income to arrive at adjusted total income. Those adjustments would be called as uh, gift aid donations, or it could be pension contributions, etc., to arrive at the adjusted net income. Now, after adjusted net income is calculated, then we deduct personal allowance from this total income, and the figure that we have is total taxable income. This is the amount on which the tax liability is charged. Then again, tax liability is charged at non savings income at different rate, and dividend incomes at different rate. Non savings income, it is 20%, 40%, and 45%. Savings income, there is a nil rate band, then 0%, then no, sorry. First, there's a starting rate band which applies with respect to fulfillment of certain conditions. Then it is a nil rate band. Then again, it is 20, 40, or 45%. And for dividend, first £500 of dividend would always be exempt, irrespective of other incomes or under whichever band rate you are falling into. Then it would be 8.75%, 33.75%, and 39.35%. Though these will be given in the examination tables, but still, for the purpose of calculations and for easy when we need to move to the tax calculations, we must have these in mind. Now, the topic which we are going to cover today is the self employment income. We already do have the notes for this, so we will be quickly going through the notes because this is like a mini crash course. Now, what is self employment income? When income is earned from business, and it could be trade, it could be profession, or it could be vocation. Now, from trade, which means sale and purchase of goods, then when there's a sale and purchase of services, like the profession of chartered accountant, doctor, lawyer, or you could be earning money from the vocation, which is hobbies, example, cooking. So that is called as self employment income, which means when you're working for your own self and not for somebody else. And when you're working for somebody else, that's employment income. So now, when do we classify that yes, when I'm earning money from this thing, it's actually a trade, or it's actually the taxable portion of money that I'm earning? Now, for example, I'm having one very nice wardrobe with me, and now one day I just plan to go and sell certain things out of that in the market. So is that a trade? There, it may be, it may not be. We will study about this in the next points. Now, another example, I have a house property, and one day I go and try to find a buyer who will buy this property. So is that a trade? May or may not be, again because of fulfillment of certain conditions. So when we need to check that whether these conditions are being fulfilled for a business to be considered as trade, we need to check the badges of trade. To classify as a trade, following badges of trade are to be checked. Now a mnemonic is given for that. That badges of trade mnemonic is so firm and fast. So to start with, first, S. What is the subject matter of this trade? See, whenever we buy any goods, there could be three reasons for that. Either I want to use it for my personal purpose, or I have bought it for the purpose of selling it in the market, which is inventory. And the third could be the capital asset, for example, house property. So when I'm buying something, the goods or asset for my personal use, it is not for the business purpose. Very clear. Then inventory is for the business purpose. And capital assets we will be covering under capital gains taxation. Now a simple example of capital assets. Now me buying a property and selling it in the market, am I going to do this daily, or is it my frequent transaction? No. So it is a capital asset for me. But for a property dealer who is frequently doing transactions of buying and selling of properties, it may not be a capital asset for him, it may be a inventory for him, so that may be for his business. So we need to check depending on the circumstances of case that what is the subject matter of this transaction. Then next is O is ownership. So what is ownership? Which means for how much time I am sorry, for how much time I am owning this property. What is the length of ownership? For how much time is the asset purchased? Now, if my intention is to keep this asset for a longer period of time, for example, I'm investing in shares or securities, and I'm investing it in for a shorter period of a longer period of time, which means I'm just investing it and I want to earn capital benefits on that, or I want to earn enduring benefits from that. But if I have the intention to sell it in a shorter period, now for example, like there are short trades, that people do on daily basis, in case of shares, or when you're keeping that asset for a short period so that whenever the price goes high you just sell it to earn the profit. So the length of ownership, whether it is a short term ownership, which means the intention is to sell, so that will be classified as inventory. And when it is long term, the intention is to keep the investment for a longer period. The third the third factor to check that whether this will be classified as a trade or not is F, which is frequency of transactions, which we have already covered. Something is done once, or something is being done on a repetitive basis. Again, the In the example was property. If I am buying it for myself, that would be my investment. But if the property dealer is buying this property and selling it, again buying, again selling it, which means it is a part of his trade, he is doing these transactions multiple times. So this is called as a part of trade. Next is I means improvement. What improvement? How do we classify that, whether improvement is done and then it will be classified as trade? Now let's say when assets are modified to make it more saleable. For example, there was a case law also regarding this, that a person had bought ship and then he carried out certain improvements on that ship to make it in a working condition. So when the improvements are done on the certain asset to bring it into the moving condition, or when the asset is already in use but you are trying to make some modifications on that to make it more saleable. The another case law of this example was the cinemas, where a person acquired a cinema, then the movies are being played there, but then he's doing certain renovation things on that cinema. So when the renovation thing is done, the improvements are done, that is called as improvement. But bringing the asset to a moving condition, for example in case of the ships, is called as not improvement for the purpose of trade, but to bring the asset to moving condition. So two different aspects are there which need to be considered. So I for improvement, which is modification of asset to make it more saleable. Example, goods purchased and some labels are being put on that, or some packagings are done and then these are sold. So this is inventory, which means it is a part of trade. Now the next factor to be considered is reason for sale. What is the reason for sale? Now for example, I need 100,000 pounds for some specific purpose, and I do have a asset to earn that 100,000 pounds which I don't have readily available with me. I sell my asset. So was that sale actually a part of my trade? No, that was a forced sale. So the reason of sale also has to be considered. If it is a forced sale, it is not a trade. Trade has to be like a ordinary part. It has to be done multiple times, then frequencies have to be checked. So the reason of trade also needs to be considered. Forced sale, if you are in needs of funds, so that's why the asset was sold. So this is not a business nature, which means it is not a trade, right? Next is M for motive. Motive, which motive are we talking about? We are talking about the profit earning motive here. Now if the person wants to earn profit from the selling of those goods or services, or the motive is okay, I'll explain it with the help of example. Now, let's say I am buying certain clothes on daily basis and keeping it as a stock, so that I'll keep it in my store and then sell it at a later period of time to earn profits on that. This could be one reason. The motive is profit. But the second example for this would be, let's say I inherited certain assets from my family. Now, the inheritance of those assets which I got as a gift. Now, in future, when I go to sell that, I never bought that asset in first place. So now, when I'll go and sell it, the intention was never to earn profit, because I never bought it to earn profit. I was gifted this. So there should be profit earning motive. It is not the existence of profit that is important, rather, there should be a motive to earn profit. Motive to earn profit would be determined when you're buying it in the first place for the purpose of selling it and earning profit from that. So we have done the first mnemonic, which is so firm, SOFIRM, subject matter, whether it is for personal use, inventory, or capital asset. Then ownership, whether what is the length of ownership. If it is for long term, it's an investment. If it is for short term, it is inventory. Then frequency of transactions, how often are you trading, how often you're selling or buying the goods. Then improvement, whether capital improvements are being done, which means whether the improvements are being done to make the asset into movable condition, or the other modifications are being done, like packaging, putting some labels on that, because putting labels and packaging would be treated as inventory and the part of trade. Then the next was R, which is reason of sale. Reason of sale would be, it should not be a forced sale. And the last was M, which is motive. So there should be a profit earning motive. It is not the existence of profit, whether you're earning profit or not, or the amount of profit does not matter, but you had the intention to earn profit or not is what really matters. Now, the second mnemonic is FAST, FAST. Now, what this mnemonic says, the first F, it says finance, whether the goods were purchased on loan. Now, we need to check the nature of finance. If it was a business loan, like um, we take working capital loans, etc., for business, or asset loans for the purpose of buying the assets in the business, so it is a trade. Otherwise, if it is a personal loan, personal finance, then that has to be excluded from the trade. For example, if the asset is purchased on a short term loan and a businessman is unable to fund this loan without selling assets, it is a trade. Now, what does this mean? Now, a businessman has certain assets which he wants to sell. No, let's again begin that. Businessman wants to buy certain assets, but he does not have money for that. Now, he's taking a short term loan from the bank. How he will repay this loan? He will sell these assets, earn profits from that. This profit will be used to repay back the loan. So if the asset is purchased on a short term loan and businessman will refund this loan by selling the assets, it is a trade, which means the nature of finance has to be checked, whether it is a long term loan, business loan, short term loan, and what is the intention of getting that loan. The next is A, which means mode of acquisition. uh, I think the example we have already discussed. If the asset was acquired through inheritance, example, Mr. X got a gift of house from his father. The motive was not to sell in the first place, so it is not a trade. And the last is ST. ST is similar trading transactions. Similar trading transactions, again, I think a similar example was discussed before, which means let's take the example of a property dealer buying and selling of properties multiple times in a month by a property dealer. This is a trading activity because he is doing these trading transactions, similar trading transactions on day to day basis, weekly basis, monthly basis. So that has to be considered. So, the first topic regarding what are considered as the badges of trade we have discussed. And yes, do bear in mind that this is not just the theory part. I have seen two or three past examination question papers where a certain scenario would be given and then it will be asked in around 5 to 7 marks that yes, if this person is carrying out so and so activity, determine under the badges of trade that whether this is a trade or not, whether this was actually a business activity or not. So don't consider it just as like the learning points, because you must be able to fit in these points to answer the questions. So to revise it again, following badges of trade are to be checked: so, firm and fast, which means subject matter, then ownership, then frequency of transactions, improvement, then reason for sale and motive to earn profit. And then fast is finance, what is the nature of finance, what is the mode of acquisition, and if there are similar business transactions, similar trading transactions carrying on, then that will be considered as a trade. Now, the second topic is basis of assessment. uh, this is the point from where this chapter's taxability part starts. So, in the property income, we discussed that the basis of assessment is usually the cash basis, which means the rent received and rent paid during the year, and the period won't matter. But here it's on accrual basis, which means receivable, whether it is actually received in the year or not, and payable, whether the expenses are actually paid in the tax year or not. Now, this topic's taxation would be a bit different from the other topics because there we are directly dealing in the relevant tax year itself. But for self-employed individuals, what would normally happen is they will be preparing accounts for a different set of period, but the tax year would always run from 6th April to 5th April. So here certain adjustments have to be made. Now let's read this. Accounts are prepared for a financial year or period. For example, accounts are generally prepared by individuals from 1st April to 31st March, or it could be from 1st January to 31st December. But the tax year is always from 6th April to 5th April. So, which year to be considered? So, before 23-24 tax year, what was happening was the accounting period which was ending in a tax year, that tax year was considered. So, how do I explain this? Let's say the accounting year was running from 1st January 2022 to 31st December 2022, right? So, first of all, when this accounting year is ending, 31st December 2022, this December 2022 falls in tax year 22-23 because the tax year runs from 6th April 2022 to 5th April 2023. So this falls in this period. So earlier, I mean before tax year 23-24, what used to happen was whenever this accounting period will end in whichever tax period, the profits were taxed in that period. But after 23-24, which means this one is relevant for your examination because we are studying for tax year 24-25 and also Finance Act 24. So, apportion the income in the relevant tax year. What does this mean? Now, let's say the accounting period is 1st Jan 2022 to 31st December 2022. So, 1st Jan 2022, which period tax year it falls under? It falls under tax year 21-22 because this will be 6th April 21 to 5th April 22. So this will fall under tax year 21-22. And then 31st December. This will fall in tax year 22-23 because it falls somewhere here 6th April 22 to 5th April 2023. So profits are relevantly apportioned. So what is the purpose of doing this? The purpose of doing this is in the tax years, the rates of taxation may be different. So, let's say, just for example, for your understanding, let's say in tax year 21-22, the rate of taxation on profits was 19%. But in 22-23, the rate of tax, let's say, turned out to 25%. This is not the exact one, this we will study in the corporation tax chapters, but still, let so, to determine the exact rate of tax on these profits, the ultimate apportionment has to be done with respect to specific tax years. Hope that is clear. Now, the next topic. From here, the calculation part begins. Tax adjusted trading profit. First, I'll just take you through the performer and then we will discuss the adjustments one by one. Now, tax adjusted performer, a trading profits performer. We start with net profits per accounts because we'll have prepared the books of accounts and then we take the net profit from there. Now, when we were preparing accounts, there would be certain expenses that we would have deducted. These expenses would be accountancy fee, or it could be administration fee, then it could be entertainment costs, depreciation, amortization, stationery, office supplies, etc. So expenses were deducted, but HMRC says that certain expenses we don't consider that these should be deducted, which means these expenses should be disallowed. So what was subtracted before, we are adding it back now. Add expenses which are not allowed for the tax purposes, which means these are disallowed. Expenses allowable for tax purposes. Now, the example for this expenses not allowed for tax purposes, let's say, is depreciation, a simple example. The reason behind this also we will discuss in the upcoming part. Expenses allowable for tax purposes. Let's say this is um, office expenses basically. For example, okay, even if office expenses are allowed, we will show it as nil in the tax computation that you will show in exam. No treatment of this because it is already deducted, but you have to show it as zero when you show it in your exam. Now, trading profits which are not credited in accounts, then less expenses not charged in accounts but allowed for tax purposes. Incomes included in accounts that is not taxable for trading profits, deduct. And once you arrive at a certain profits, now, as we discussed here, that depreciation is a disallowable expense, but because the reasons for this, let's discuss just after that. Now, if depreciation is not allowed, HMRC is saying we help you allow a portion of depreciation, which in taxation terms is called as capital allowance. So this is equivalent to HMRC's depreciation. And once capital allowance is also deducted, then we arrive at tax adjusted trading profits, which is TTP. This is the amount on which tax is paid. Now, what are the disallowed expenses? See, we did in property taxation also that the journal rule is, the golden rule is wholly and exclusively for property business. Those expenses should be. Similarly, is in self employment income that the expenses which are not incurred wholly and exclusively for trading purposes will be disallowed. Now, what are the adjustments in trading taxable profits that have to be made to arrive at the ultimate profit, to derive at the tax figure? The first is depreciation. Now, let me explain this in simple terms why this is not allowed, because till now we would just have been told that okay, add back depreciation, add back amortization, but what is the actual reason behind that? There is a link between balance sheet and P&L. Now, whenever you're buying assets, you will put that assets in your balance sheet, which means these are long term assets and you directly show these long term assets in the balance sheet. But these assets are used for the running of business, the plant and machinery, the vehicles, the buildings. Building is not for running the business, but building is somewhere where the business is run inside. So the long term assets will be shown in the balance sheet. So should I not show the equivalent cost of using these assets on yearly basis? Yes, the equivalent cost on yearly basis is shown in the balance sheet. But these capital assets that are shown in balance sheet, they have a enduring benefit. What do you mean by enduring benefit? That they have a long term benefit. It's not just for 1 year, it is for the multiple years. So something which is for, and we are calculating tax profits for just 1 year, so why should I deduct something which has a benefit for a longer period and I just deduct in the profits of next year? Which means for a fair approach, it should be deducted from all the respective years when that asset was used. That's why we deduct the depreciation. I hope this is clear. Now let's read from here. Depreciation. There is a link between balance sheet and P&L. Capital assets are used in business on daily basis, right? So a cost needs to be recognized in P&L. Why P&L? Because it's used in the business on daily basis. Now, let's say a capital asset, example car, was bought for £10,000 and it was used for 5 years. So cost should be booked on yearly basis, right? But what happens is 10,000 will sit in the balance sheet and 2,000 will be treated as cost of using this car on yearly basis, right? So that is why this is deducted in the yearly cost, which is depreciation, is deducted in the balance sheet. But because it has a enduring benefit, HMRC says that we can't allow a asset which has enduring benefit to be treated as a part of taxable trading profits. That is why depreciation is disallowed. Similar reasoning is for amortization. The only difference is depreciation is for the tangible fixed assets and amortization is for the intangible assets. Again, another reason why depreciation and amortization are not allowed. See, we know that depreciation and amortization, there are various methods of calculating this. It could be straight line method, it could be WDV method, which is written down value method. Now, what a trader would generally try to do is he will try to find out the ways in which more and more depreciation can be booked by his business, whether it is by SLM or whether it is by WDV or any other method. So that is why HMRC says that for everyone to stay at the same pace, let's just disallow this. So, why depreciation and amortization are not allowed in calculating the TTPs? Because there are many rates and methods of calculations, and traders will usually use a method which will maximize the tax relief. So, I hope the reasoning is clear as to why depreciation and amortization are not allowed. Instead, but is it that business will just keep on purchasing the capital assets and will never be allowed to deduct any cost while arriving at the taxable profits? No. Equivalent to depreciation is something called as capital allowance, which HMRC allows to arrive at the taxable profits. Capital allowances, there's a separate chapter for that, so we'll discuss it in some another video. But for this chapter, we'll just treat it as something which is equivalent to depreciation. Now, the first golden rule was that uh, the expenses should be wholly and exclusively for the purpose of trade. Only then it will be allowed, but if it is not, then this expense will be disallowed. Then certain adjustments we started discussing about. One was depreciation, amortization. The only thing was so that people don't use different rates to maximize their tax relief, and also because these assets have enduring benefits, so that is why depreciation and amortization are disallowed. Now, capital expenditure, again, it has something to do with part 1 or 2, which we have discussed, depreciation and amortization. When purchase of capital assets are done, these are included in balance sheet as fixed assets, so capital expenditure will not altogether be allowed. Rather, they will be eligible for capital allowances. Now, let's say there was a legal fee also. So, you know that whenever some properties are purchased, you have to pay the fee to solicitors, etc. So, will that legal fee also be allowed on these capital expenditures? No, because the ultimate expenditure that is being carried out is capital in nature. So, any expenses incidental to that acquisition will also not be allowed. But uh, if you remember, we did something as short term lease in the property taxation chapter. So if any legal fee is paid, or any fee is paid on the renewal of that short term lease, yes, that is allowed. But if it is on a long term, let's say it is not a short term lease, it is a long term lease, so would that be allowed? No, because that itself was a capital expenditure, and we were going to treat it in chargeable gains and not in the income tax, so that would not be allowed. So, which means profits or loss on the sale of capital expenditure are also not allowed, because they are not trading expenditures or gains. Which means, let's say you buy a property, then you sell that property, you earn profit on that property. Is that a trading income from trading? No, because selling of properties is not your trade. So, profits and loss on sale of these capital expenditures will also not be allowed. The fourth topic, which is a common adjustment and is mostly asked in exams, is repairs. Now, three types we have to study here. First, repair, which restores the assets to its original condition. Now, what do you mean by that? Let's say there were some broken tiles, and then a repair has been done to replace the asset to its original condition, which means some new tiles were put instead of that to replace it to the original condition. Now, replacing the old thing with the new thing, but with a modern technology, would that matter? No, because ultimately you're just replacing the original one with the new one. And after the work is carried out, asset can do the same job as before. So two things need to be considered. One, that the asset is brought back to the original condition, and secondly, that the asset can do the same job as before. So those repairs would be allowed. But what if you're replacing the full asset? Replacing the full asset is again a capital expenditure, so that is disallowed. Or if any significant alterations, here we were talking about just bringing to the original condition. But what if the significant alterations or improvements are done, which means something has been done now which could not be done before, so that is called a significant alteration or improvement, so that will also be disallowed. Let's read this. When an asset can do something which could not be done before, that is called a significant alteration or improvement. Then replacement of asset is also disallowed. And then repairs, when the asset is restored to the original condition, it is called as repair, that would be allowed. Replacing a part of asset is repair, but replacing the whole of asset is a capital expenditure. Now, initial repairs. So, initial repairs, they are part and parcel of acquisition cost as they enable the asset to perform its functions. So, capital asset. Remember, I was giving you the example of ships and cinemas, that falls here. However, when asset was purchased in a usable state and then repairs were carried out, that is a revenue expenditure, which means the cinema example will fall here. That movies were being played, but slowly and slowly the owner of this cinema, he started renovating it so that it is more likable by the persons coming there. But if it is to bring it into a working condition before actually using that asset, then the ship example would come there. Now, next is provisions. Provisions, when can they be recognized as expense? When the so here basically is the definition of provisions. When there is an obligation to make the payment, when some money has to go out from your pocket, there is transfer of economic benefit, and you can make a reliable estimate of the amount of this provision. Then, next is private expense of employees. Now, when the employer is paying for the private expenses of employees, in the employment chapter we will discuss this, that employer is reimbursing certain expenses to the employee and so on. So this will be treated as a taxable benefit for the employee because he's getting certain benefits apart from just his salary. And if one person is paying the tax, employee is paying the tax, this will be treated as deductible for employer. Do bear in mind that here we are discussing about private expense of employees, example gym membership, etc. Now, next is clothing. Now, there was a case law regarding this, that clothing expense, whether it should be allowed or not. In that case law, it was that a lawyer who buys a suit to go for a hearing, she wanted to deduct the cost of that clothing from her profits. Now, whether that was allowed? No, because HMRC said that there is a duality of purpose. It's not that you can use this suit only for the purpose of your profession, but also this clothing thing helps you provide warmth and decency also. So, which means that is a private use thing also. So, cost of buying clothes is generally disallowed. But again, there's a catch. Now, somebody who is into a construction business, they are provided safety jackets. Then somebody who is in a working in a hotel, sorry, somebody who's working in a hotel, they're getting chef aprons. So, is it providing warmth and decency? It could be, but the primary purpose here is that it is specifically for the purpose of business. So those are allowed. Let's read this. Clothing. There's a duality of purpose in clothing. It is not only used for work, but it also provides warmth and decency. So cost of buying clothes is disallowed. However, protective clothing like chef's aprons, any protective jackets used by construction workers, actors' costumes, etc., these are all allowed, right? Now, next is salaries and wages. Now, any amount paid by business to its employees for the work undertaken. Now, when any amount is paid to the employees, which means I am working for a ABC firm, I am getting a salary from there. I am paying tax on that. So HMRC has already taken tax from me, which means for the employer, paying my salary is the expense. So that will be a deductible expense for the employer. And for employees, it is taxable as employment income. Now, it's not only the tax that the employee is paying, but it is also the national insurance contributions that are being paid, and these are paid by employer as well as employee. So any amount which is paid by employer of national insurance on the salaries of the employees is also treated as a deductible expenditure, right? Then now, one was the employer paying salaries to the employees. But what if he is drawing the amounts for himself, which is called as appropriations or drawings? So, what are appropriations? Sorry. Then the funds which are withdrawn by employer to meet his private expenditures. For example, he's taking out a salary from his business. He is paying himself the interest paid on capital. What does that mean? For example, in case of partnerships, let's say when a partner has to enter into a partnership, he has to contribute a certain portion of capital. Let's say he doesn't have that money, he gets it funded from the bank, and then he pays that capital to the business. And on the top of that, he is getting interest from the partnership firm. So all these are called as appropriations from the business. So now, let's say it is my business. I am earning a profit of £100,000, and I'll say I am the main owner of this person. I am doing all the technical jobs and everything. So my salary should be £80,000. So is that justified? Because anybody would come up and say that okay, the maximum amount of salary I want to deduct from the profits. So that I want to reduce my profit. So HMRC will not allow the deduction of salaries or wages which are paid to the employer himself, because he will then obviously take the advantage of that and reduce the maximum amount possible from the profits. But let's say in my business, my spouse is also working along with me. So I'll say, okay, my spouse is also doing all the technical things and all, so he is also paid 80,000. But here HMRC will say okay, your spouse is helping out in your business, but what if this was not your spouse and this was some third person with whom you are not connected? How much amount you would have paid to that person? I would say, okay, if I will keep this person as my employee, I'll pay him £50,000. So, which means the salary of spouse should also be the same as what should be paid to the unrelated person. So that is why the excess amount paid to the spouse will be treated as disallowed, which means there should be a bona fide reduction of the expense. So let's read this. Wages paid to the spouse, bona fide deductible expense provided. Now, what are the conditions that wages or salaries can be paid to the spouse? These are actually paid, it is not just a book entry. Spouse actually plays a part in the business, and it's paid at the arm's length price, which means there should be a price which is similar to the price paid to the unrelated party. Next part is wages paid to the children. It is also allowed which if the payment is actually a wage and it is not a pocket money, and it is not unreasonable for a child to be employed to undertake that work. Now, whenever the employer is paying wages or salaries to his employees, we know that self-employment income, it's generally deductible on accrual basis. But HMRC says that in this way, what you people will start doing is you will not pay your employees and all for 1 years, 2 years, but you will start taking the benefit. So there's a condition in the favor of employees here. HMRC says that if you have made the payment within 9 months from when they were actually due, yes, you can deduct it from the profits. But if you have not made the payments within 9 months, disallow those payments, disallow those wages, and whenever you actually make the payment of wages, go and deduct in that year. Let's read this. Deduction is allowed as long as the wages are paid within 9 months of the end of the accounting period, otherwise allowed in the period of actual payment. Hope this is clear. Now, which income? Till now we were discussing about expenses, which were the disallowed expenses. Now we will discuss about which are the incomes which are not taxed as trading income. We clearly know that rental income, it's not a trading income because it is something totally different. Then interest from banks, then profit on sale of fixed assets, etc. Now, exception, where business premises are being let out to meet the temporary surplus requirements and letting receipts are relatively small. Now, what HMRC is saying is, you have a business premise. Let's say there are 3 floors in that. The ground level floor is empty for the time being because no activity is being carried out, and the business is in requirement of funds also. So why not let out that ground floor, earn some money, put that money into business and carry out your routine activities? Isn't it the right option? So just letting it out for a small period of time, would that be considered as a property income? No, that's not considered as a property income, because ultimately you're trying to gather funds to earn trading income from that. So what they say is, where business premises are being let out to meet the temporary surplus requirements and letting receipts are relatively small, then rental income will be treated as arising from trade and not property income. I hope this is clear. Now, next is income on long term service contracts. Now, in service contracts, let's say the construction contracts, what happens is this will not complete in a period of 2 months or 6 months or 1 year. Sometimes it can take longer period of time also. So when should the income be taxable on that? Recognize the work in progress within accounts and pay tax on when the work arises and not when the work is finally completed. Which means, let's say there will be billing conditions, 50% to be paid when the first floor is done, 50% to be paid when this much, like on the fulfillment of certain work in progress conditions, the amounts have to be taken as income, and accordingly the tax has to be paid. Now, there will be certain common adjustments which will be asked in your examination, uh, and mostly like 90% of the adjustments will mostly come from these which we are going to study now, and these are like so simple. But yes, we just have to keep them in mind, that what are the adjustments. So this is the last topic of this chapter, and then the self employment income will be uh, totally covered. And I would say try attempting more and more and more questions, because it is from the questions where you can actually make the application of these topics which we have studied now. Now, what are the common adjustments? First is pre-trading expenditure. Now, a business would have carried out certain expenses even before the start of the business. For example, research and development expense that would have been carried out. Now, HMRC says yes, this was done before the commencement of your business, but still it would be treated as allowed, provided this expense was incurred 7 years before the business commencement. Because generally the research and development, there was a case law also for this, maximum it is treated for 7 years. So expenses incurred in 7 years before business commencement are treated as incurred on the first day of trading, so which means these are allowed. Then interest payments, if the loan is for business purpose like buying stocks and assets, it is allowed. If it is for a mixed purpose, for example you're buying a car, the car will not only be used for business purpose, because it is a sole trader, he'll be using it for personal private purposes also. So this interest payments which is for a mixed purpose will be allowed only for the business purpose. Now in question you will be given that the businessman used car 70% for his business purpose and 30% for this. So whenever you're doing any such adjustment, try to include only 70, I mean, not try. What you have to do is 70% has to be allowed and 30% has to be again disallowed. Now, no deduction is allowed for repayment of capital, which means when you're, for example, you're taking a mortgage from the bank, right? The mortgage is of £100,000. Now you're paying the interest amount also on this and the installments amount also. So on the installments amount, the deduction is not allowed. The deduction is only allowed on the interest factor. Then incidental costs of obtaining the loans. For example, there may be arrangement fees, there may be processing costs, etc. All these costs are also allowed because it's again part and parcel of the loan cost. Then no deduction on interest on overdue tax. Now HMRC says that self assessment tax has to be paid by 31st January. Now you're not paying it for, let's say, 5 months. Now this was the overdue tax on which you have to pay the interest also. This is kind of a penal obligation that HMRC is charging on you, which means interest is being charged. So, will that be allowed? No, because that was a statutory obligation to pay the tax on time, and now that you have not done that, that is why HMRC is charging interest from you on that amount. So, no deduction for interest on overdue tax, as this is not an exempt for making profits. The third point is bad debts. If the bad debts are written off in a year, these are deductible expenditures, provided the bad debts are only and only for the trade, are only and only relating to trade debt. Similarly, loans to employees, if they are written off, these will be treated again. Loans to employees, when the employer gives a loan to the employee, let's say in a future period, employee terminates or employee does not have like sufficient amount to pay back this loan, this is treated as additional benefit for the employee. And whenever there is a thing of benefits to the employee, that amount is always and always taxable in the hands of employee. So if employee is paying tax, why should employer be paying the double tax on that? Which means whenever loans to employees are written off, this will be treated as additional salary for the employees, so deductible for the employer. Next is accountancy fee. Now, sole trader is paying the accountancy fee for the preparation of his accounts. Yes, because his business is there, so he needs to prepare the accounts. Yes, that would be allowed. But let's say for the preparation of his personal tax return, it already includes personal. So that is for his personal purpose, which means it is not allowed because this personal taxation was not for this business. Rather, it was for his other incomes also. So that is why accountancy fee for this is not allowed, right? Then next is termination payments. To whom the termination payments are made? To the employees. This could be due to like when the employee has, you know um, suffered a serious injury. It could be due to the death of employee, the termination payments are made. Then it could be due to loss of office, means when redundancies are done. So whenever there is a cessation of trade, you can't argue that this was wholly and exclusively for trade, because if there is no longer a trade, how can that expense be relating to trade, right? So termination payments are not allowed with respect to this logic. But under employment laws says that whenever termination payments are being made, they should be allowed as a expenditure. If the business wants to be more generous and pay more amount, now employment law specifies a certain amount, that this should be amount which should be mandatorily paid to the employees. But now that the employer says that no, I want to pay more amount than this, would that be allowed? Yes, that would be allowed, but the maximum relief allowed would be whatever is the statutory redundancy level. You can just pay 3 times more than that and not more. Then next is travel and subsistence. Travel and subsistence, this will include traveling from home to workplace, because you're going from home to your office, or it could be from workplace, from home directly to your client's place, or it could be from workplace to your client's place. You need to consider different scenarios. But traveling from home to workplace, even if living, let's say I'm living in London and my um, workplace is somewhere in let's say Birmingham. So do I need to go? I need to go there daily. That is my obligation. I have to go to my workplace. So will employer pay me for that? No. Why should the employer pay me for that? It is my responsibility. It is my duty. Wherever I want to stay, I can, but employer will not come and compensate me for that. But now that you're traveling from home to your client's place for the performance of your duties, yes, then the travel expenditures would be allowed. And when you're going for that travel, let's say you're going by train from London to Birmingham, the train tickets, the travel expenses would be allowed. In the course of that, you are taking up certain meals. Example, you were going to Birmingham, on the way you grabbed a coffee and a burger. So, would those expenses also be allowed? These were not wholly and exclusively for business, but yes, these were incidental to the travel costs. So, these will be called as subsistence expenses. So, reimbursement of employee home to work expenditure is also allowed, and subsistence expenses is also allowed. Expenses incurred by traders on food and drinks that we were talking about whilst traveling for business are called as subsistence costs, and these are allowed. Now, next is training costs for trader himself. When the trader is trying to learn a new expertise, because without that expertise he cannot uh, perform the further duties, right? So that is considered as a capital expenditure because the cost is incurred to enable the trade in first place and then give a enduring benefit, right? But if it is like online course, for example, you're doing certain cpdrs. CPDRs is just for ongoing update or development trainings. Once qualified, these are allowed, but if you're taking that qualification in first place, that are not allowed. But if the trading training costs are for the employees, the employer is sponsoring a certain person that okay, you can go ahead and do this cost. For example, uh, my employer is saying that okay, you can go ahead and pursue ACCA. So my training costs, will that be deductible for the employer? Yes, that will be. Staff training costs, they are always allowed, whether for the staff to acquire new expertise or keep up to date. Next is website cost. Whenever I'm creating a website for my business, creating of website in the first place is a capital expenditure because it will give enduring benefits. But if on time to time basis I am renewing or regularly updating my website, that will be allowed because it is a revenue expenditure. So, setting up a new website is disallowed because it is a capital expenditure. It will bring enduring benefits, and regular update costs of this website will be allowed because it is a revenue expenditure. Now, premium on lease, we have already discussed it in the previous chapter. Short term lease, if it is up to 50 years old, it is treated as taxable income, but long term lease, it is chargeable to capital gains tax. Now, fines and penalties, it is not an expense for earning profits, rather, it was a statutory payment to be made for the violation of certain expenditures, and when there is a violation, those expenses are disallowed. But if the employer is now reimbursing the employee's fines and expenses, reimbursement is taxable for the employee and deductible for the employer. Next is subscriptions. Now, let's say there are certain subscriptions like tax journals, tax advisor magazines. I have subscribed it on like monthly basis. So will these subscriptions be allowed? Yes, wholly and exclusively for trade. But if non-trade subscriptions, let's say I'm purchasing a subscription for the gym membership, will that be allowed? No, it is not relating to trade, so why would it be allowed? That is disallowed expenditure. Then donations. Donations again, if it is wholly and exclusive for business. Now you will think, why how can donations be wholly and exclusively for business? For example, when I'm trying to promote my business name, right? Then the conditions are, if it is made to registered charity, it should be local and reasonable in size in relation to business making donations. What does this mean now? Now, let's say the business is earning a profit of £100,000 and to the charity it's paying £90,000. Now, this is the practical case that I have also faced in my office. The the trader was earning £100,000. They made £90,000. The numbers are, just imaginary numbers I'm taking to describe the case. So 100,000 pounds was the profit. 90,000 pounds was paid by this trader to the donation. So HMRC came up, they said, so did you keep just 10,000 for your living costs? How are you meeting the living costs throughout the year if this was the yearly profit and just 10,000 you kept it in your pocket? Was that 10,000 enough for you to stay? So that could also be asked as a question. It's not that you are paying lump sum amounts to the donations, that is not allowed. So this is what it means: local and reasonable in size in relation to the business making donation. Now, if donation is disallowed, why disallowed? Because any of these conditions would not be met, but payment was made to charity. So as I was talking on the first page, that gift aid donations reliefs can be claimed. So taxpayer can claim relief under gift aid provisions. Yes, we will discuss it when we will discuss the comprehensive questions. Now, if any subscriptions and donations are made to political parties, they are disallowed. Next is entertaining expenses. Entertainment expenses could be like meals for employees or etc. But now clients are coming, you're paying entertainment expenses for that. What's the treatment? These expenses are generally disallowed except if it is for the employees only. Then, next is gifts to customers. For gifts to customers to be allowed, if it is per recipient you are giving to the customer less than 50 pounds, the per gift is less than 50 pounds, and it should be per recipient per year. If it exceeds more than 50 pounds, then full amount is disallowable. Then it should not be a food gift or drink or tobacco or vouchers which are exchangeable for goods and carries the advertisement of business making profits. All these three conditions have to be fulfilled for the gifts to customers to be allowed as a expenditure. But if the gifts of business samples are given just to advertise the products, those will be allowed. Now, next, other adjustments. Business private residence is used for work partly. Business portion of expenses is allowed. Business calls from private telephone are also allowed. Expenses wholly and exclusively for trade from private funds of the employer allowed. See, till now, whatever we have done is the reasoning for a expense to be allowed or not depends on certain factors. Wholly and exclusively for business, whether it is a capital expenditure, whether it is a personal expenditure. These three conditions, if you fall under any of these boxes, yes, not wholly and exclusively for business, not allowed. Capital expenditure, not allowed. Personal expenditure, not allowed. So even if you're not able to understand that, yes, whether this expense, for example, website costs, is it wholly and exclusively for business? Yes. Is it a private expenditure? No, it's not a private expenditure, should be allowed. Is it a capital expenditure? Yes, because it is going to give me an enduring benefit. But I am just updating my website. Oh, yes, so it is not a capital expenditure. So all three boxes are ticked. Yes, so that can be allowed. So this is how easily you can check that whether an expenditure can be allowed or not. Then flat rate expenses. uh, this we will cover in the topic when there will be a specific topic for flat rate expenses. I will try and cover this in that video. Then next is when employer is making contribution to pension scheme, it is like ultimately encouraging the employees for retirement benefits. Yes, that will be allowed, but only when it is paid. Now, the last topic is when the employer is using the goods for his own use, which means withdrawing the goods for his own use. What does that mean? That means is removal of goods accounted for in profits. This I will try to explain here. When the goods were bought, these were shown in inventory. Now, when they had to be sold, they were shown in cost of sales. Right? These would be the things done in accounts. But let's say a businessman bought a computer for his business, but now he's taking this computer for the use of his daughter who is studying, which means removal of goods. Removal of goods in both cases. In the first place, this purchase of computer was accounted in accounts. When it was accounted in accounts, it was shown in accounts, which means it was recorded as inventory. and cost was also recorded, so cost of sales. But now HMRC says whenever a businessman is taking out assets from the business or goods from the business, it is treated as sales even though it was a sale to himself. So when businessman will take out this computer for himself, he will not record the selling price. So selling price less cost of sales is profit. Cost of sales is recorded, selling price is not recorded, which means I'm trying to undervalue the profit in my books of accounts. So if this is treated, what else should be treated so that profit is recorded? Selling price, which means when accounted in the accounts, which means cost of sales was shown in accounts, then add back. What we need to add back? Profit, because we never showed the selling price of this. But it was never recorded. Removal of goods was not recorded in accounts, which means in the first place this computer itself was not shown. Then what we need to do is we need to add back the full selling price of this computer to arrive at the trading taxable profits. Hope this is clear. These are the major adjustments which are asked in the 18 marks questions in the ATT exam, and also in the ACCA exams. This is very important. Now I'll tell you which main adjustments should be looked into while revising. One is goods for own use is the major adjustment. Currently, this in London it's then this will be asked as a very small point somewhere in any one of the questions. Then gifts to customers, sometimes it is asked as a 2 mark, sometimes it's shown as an adjustment in the long questions. Then subscriptions mostly is asked. Training costs is one which is mostly asked. This is very important. I mean, all of these are important, so just go through this and then you will be able to solve 90% of the self employment question that is asked in your exam. So, this was all about taxation of self employment income. If you do have any questions or you have not understood any of the topic, do comment in the comment section. I would recommend solve maximum questions so that you can come up with more confidence whenever you go for your exam. That was all for today. Thank you. We shall meet in the next video.